Hello student, in this video we will do sums based on traditional approach to accounting. Classify the following accounts into personal, real and nominal account. Cash account, real account, bank is personal, outstanding salaries personal, sales nominal, accrued interest is personal, leasehold property is real account, drawings is personal account, discount received is nominal account, bad debts written off is nominal account, purchases is nominal account, bad debts recovered is also nominal account, plant and machinery real, capital personal account, interest paid nominal account, bank overdraft personal account, prepaid rent personal account, carriage inwards nominal account, goodwill real account, rent received is nominal account, rent received in advance is personal account. Let's analyze a few transactions using traditional approach. Suresh started business with cash 50,000 rupees. Now as per the accounting equation, we will increase the cash and also increase the capital. So the accounts involved are cash account and capital account. Cash account is a real account and capital account is a personal account. The rule for real account is debit what comes in, credit what goes out. So cash comes into the business, so debit what comes in. So we need to debit cash account with 50,000 rupees. The rule for personal account is debit the receiver, credit the giver. The proprietor's account is represented by the capital account. The proprietor is the giver of the amount. So debit the receiver, credit the giver. In this case, credit the giver. So we need to credit the capital account with 50,000 rupees. Purchase goods for cash rupees 10,000. Now whenever stock account is involved, there are only 4 options. One is purchases, the other is sales, the third is purchase return, and the other is sales return. So stock is involved over here, but we have purchased the stock, so we use the account of purchases account. And the other account involved is cash account. Purchases is a nominal account. Cash account is a real account. The rule for nominal account is debit all expenses and losses and credit all incomes and gains. Purchase is an expense, so debit all expenses. We need to debit the purchases account with 10,000 rupees. The rule for real account is debit what comes in, credit what goes out. In this case, the cash is going out, so credit what goes out. we need to credit the cash account with 10,000 rupees. Sold goods for cash rupees 15,000. And the accounting equation, cash will increase by 15,000 and stock will reduce. As I said, for stock we use either purchase account, sales account, purchase return or sales return. In this case it's sales account instead of the stock account. The two accounts involved are cash account and sales account. Cash account is a real account. Sales account is a nominal account. Rule for real is debit what comes in, credit what goes out. So cash comes into the business, so debit what comes in. The rule for nominal account is debit all expenses and losses, credit all incomes and gains. Sales is a income for the business, so credit all incomes and gains. So we will debit cash account with 15,000 rupees and credit sales account with 15,000 rupees. Received interest from Manoj in cash rupees 500. Now interest is a nominal account. Whenever a nominal account is involved, we need to use the name of the nominal account and not the recipient or the payer. So here we receive cash in the form of interest. So the two accounts involved are cash account and interest account. Cash account is a real account. Interest account is a nominal account. The rule for real account, debit what comes in, credit what goes out. So in this case cash comes in, so debit what comes in. Interest, nominal account, debit all expenses and losses, credit all incomes and gains. Interest is an income, so credit all incomes and gains. So we need to debit cash account with 500 rupees and credit interest account with 500 rupees. The next transaction, sold goods to Samir rupees 6,000. In the accounting equation, the stock will reduce by 6,000 and debtor or Samir's account will increase by 6,000. So let's write the two accounts involved. One is Samir's account and the other is sales account. Samir is a personal account. Sales is a nominal account. The rule for personal account is debit the receiver, credit the giver. Samir is the receiver of goods, so debit the receiver. Nominal account rule, debit all expenses and losses, credit all incomes and gains. Sales is an income or gain, so credit all incomes. So we need to debit Samir's account with 6,000 rupees and credit sales account with 6,000 rupees. Purchases furniture for cash rupees 5,000. The two accounts involved in the accounting equation, the furniture increases and the cash reduces in the accounting equation. So the two accounts involved are furniture account and cash account. Furniture is a real account. Cash account is also a real account. The rule for real account is debit what comes in, credit what goes out. Furniture comes in, so debit what comes in. Cash goes out, credit what goes out. So we need to debit the furniture account with 5,000 rupees and credit the cash account with 5,000 rupees. Paid wages 20,000. It's a nominal account. The two accounts involved are the nominal account, which is wages, and the cash account. So wages is a nominal account. Cash account is a real account. Rule for nominal account is debit all expenses and losses, credit all incomes and gains. In this case, it's an expense. Debit all expenses. Cash goes out, so credit what goes out in real account. So we need to debit the wages account with 20,000 rupees and credit the cash account with 20,000 rupees. So we've done a small example by looking at a few sample transactions and deciding which account to debit and which account to credit based on traditional approach to accounting.